Good morning, everyone. Am I audible at that side? Good morning. Okay. Good morning, everyone. My name is Marcel Stanford Mulepo. I'll be the tutor for this module FAC2601. I will be running through the sessions until such time where there will be an examination. So if you feel like asking a question, and there is a hand at the top whereby you can able to raise your hands, and then I will see that you are raising the hand so that you can ask the questions. And then after you finish with raising the hand, please drop it down so that we can able to move forward. This module, FAC2601, is all about the groups. So remember in FAC2601, you learned about where you were dealing with one individual group, but now we'll be focusing when the two companies, they are joining together to form one group. So in this case, it will be a consolidated financial statement. So I'm having some slides which I will be able to show with you. And then these slides will be the one to be used while you are interacting on this module. As I can see on my first screen, I do show that the name of the module and the subject of and the code. So this is the topics that we'll be dealing with today. Like it will be more covering on the learning unit 1, the learning unit number 2, and some of part of the learning unit number 3. So please feel free to ask me any question that you feel like. Is there anyone who want to ask a question? Okay. And this module, as I have said earlier, that it's more about the companies where two companies are coming together to form one company. So it's like there will be a consolidation of the statements whereby there is a statement for group company A and the statement for company B. So when these two companies, they come together, we're gonna form a one company, being a consolidated financial company. So as you can see on my screen, I do show you that how this will work. We've got a business that they get combined with the purpose of forming a one big group so that they can dominate in the industry. So you find that there is a company A and then there was a company B, but the company A saw a potential in company B and they end up wanting to make a one group whereby they want to dominate in the market. And then they see that if they consolidate, it will be a one big group which it will able to penetrate the market. So mostly the company that we in our sphere of life, like generally, the company which we see now, it will be the likes of the TFG group, which is one dominated by the Macams, Fushin, and the Total Sport. And then we have an Edcon group, which is one which is known as the Edgas. Edgas was the main company, was the parent, and then which it acquired the likes of Jet, Bodmans, CNA. This should be CNA, not Ken. And then the other one is Massmart Group, where it was more dominant by the Dion, Game, Macro, Builders Warehouse. So in a business combination, it's a transaction or the event in which the acquiree obtain a control of one or more businesses. So sometimes we can have a situation whereby you are the parent company, and then it happened that you obtain a control from the two different companies. So it means as a one parent, you end up having two subsidiaries or even three or more. So that in that case, we'll call it a business combination. And then for the purpose of this module, there will be a part whereby you'll be dealing with the financial statement from the date where we acquired the group until the current year, or a situation whereby the group was acquired now in the current financial year. So if you can go further on your study guide, you will see from the page 3, whereby we deal about the business combination. If you can all turn to the page 3 of the study guide, the current one that we are using, they do mention a summary of how did the business end up amalgamating or end up forming a group. You can hear from the study guide, they do tell us that over the years, the tendency in the business world has been a form of bigger and bigger enterprises. So we used to have the sole trader mostly as one business, and then it turns into whereby now two businesses, they come together or they end up forming a partnership. It's like my seller having the skills of accounting and also want to form a business with the BA who have a skills in taxation. So we end up being in a partnership. So in our context, we are moving from the sole trader, the partnership, but we amalgamate and forming a one group. So if you can check from the study guide, they do tell us that, however, this bigger partnership poses one problem. So if, as we say, it's a bigger partnership, it ends up creating a problem along the way. So we end up changing from bigger partnership into one group being a one company. So all the partners were not equally involved, and some partners merely contributed capital, where others more actively involved in managing the enterprise on a daily basis. The result was the formation of a business to limit the liability of the inactive partners. Companies also began to combine with other companies to form a larger companies and groups of a companies. So according to our IFRS 3, which is the one dealing with the business combination, we say our IFRS 3 regulates the business combination. We can define it as a business combination as a transaction or the event in which the acquirer obtain the control of one or more businesses, which is the one which I already illustrated, that we have a situation whereby one company acquire two or more other companies, whereby those other two or three, they will end up forming a subsidiary, being this company that acquired the control in other company will end up being the parent company. So from our study guide, again on page 4, we see an illustration whereby we've got the P limited. Our P limited will be dominated as our parent company, and we have S limited, which will be dominated as our subsidiary company. So in our case here, we see that our P limited own a 75% control in S limited. So in this case, it means P is a parent and S is our subsidiary. So where a parent is linked with a subsidiary to form a larger economic unit is customarily referred to as an entity group. And then from there, we have sometimes we can have a situation whereby our amalgamation or the group, they're going to be involved into two categories, whereby the first one will be a simple group and the second one will be a complex group. In terms of a simple group, is whereby the company have only one subsidiary. In our case, whereby you can see from the example, P is the parent company and S is a subsidiary company. So in this case, our parent company, which is P, is only have one subsidiary, which is S. And again, if you can also check on the example on page 5, the number 1 part is also that one involved it involves a complex group, whereby in this case we've got a P, which is our parent company. However, P have two subsidiaries, which is subsidiary 1 and subsidiary 2. And if you can check, on the other side, he owns 80% of the shares, and on the other side, he owns only 60% of the shares. So that one is going to be related as our complex group. So the complex group, it can be either in the form of a horizontal group, or it can be either in the form of a vertical group. So the horizontal group is the one which is dominated on figure number 1, whereby P is the parent company, S1 is the subsidiary, and another S2 is a subsidiary, whereby P is the holding company owning all two shares in these two companies, where you own 80% and you also own 60% on another company. But in terms of a vertical group, is whereby we are the parent, we own shares in a subsidiary, which is subsidiary 1. However, our subsidiary 1 also own further shares in another company, which it will be subsidiary 2. So in this case, that one is called a vertical group. So we own S1. However, S1 owns certain percentage in S2. then it should be clear to you from the above that the simple group have only one subsidiary, while the complex group, they have one or more, they have more than one subsidiaries. So you can see from the figure 2 that this one is a figure 1 and 2, they do show about the complex group. So is there anyone who want to ask a question?
Question about?
A question? I don't see any hand raised though, but I'm just allowing if someone want to ask a question.
Yes, I just want touch base on examples. Ne? Hi,
Okay.
sorry, man.
No problem. Hello.
Yeah, you said example 1, it is part of the horizontal complex group, and then example 2 is vertical complex group. Is that what you said?
The example on page 5, right?
Yes.
Of the study guide. So the example 1 is our horizontal group.
Okay.
And then example 2 will be our vertical group.
Vertical group. Okay.
If you can see, it's vertical because it's going down. Like
yes.
I'm the parent company, I own S1, and S1 owns something down further. So it can be S2, S3, S4, like that. You get it?
Yes, I can see there's a
Okay.
PLTD is the parent, and then under the parent there's a subsidiary, and the subsidiary has the subsidiary. Is that what you're saying?
Yes.
Okay.
All right. Okay. We proceed. Any other question? Okay, I will assume that we can continue further. And then if you can check on your page 6, they do just define what is the business combination, what is the parent subsidiary control. So those are just the definitions. Then we will move further to, you're still able to see my screen, right? Okay, we will move further to a wholly owned subsidiary. So a wholly owned subsidiary will be more on the lane unit number 2. There is someone whose mic is on. Please, can you switch it off? Thank you. Okay. Now we're going to go to our lane unit number 2, whereby in this case, or in this lane unit, we'll be dealing with a wholly owned subsidiary. So I guess that you already started with this module, so you know that along the way you found out that you don't own the whole subsidiary. Maybe you invested 60% of the shares in that company, and then the other 40% it remained with that subsidiary. So for this purpose of the lane unit number 2, is whereby me as the parent, I own the whole interest in that company B. So me, I'm the parent as company A, and my company B is my subsidiary, whereby I'm owning all the shares in their share capital. So it means everything that they do on their side, they have to report it back to me. So we've got 2.1, which is our introduction, whereby they do tell us that, as we explained in unit number 1, the consolidated statement of a group are in principle merely the combined statement of all the companies in the group. However, we'll have to make a certain adjustment to the statement before we can refer to them as a consolidated statement. We can represent the consolidation systematically as follows: A limited financial statement and B limited financial statement. So we adjust them all together in order to form one, and then now we form them a consolidated financial statement. Remember, company A they will be having their own transaction, which they will be doing on the daily-to-daily business, while company B, they will also having their certain transaction which they will be doing on a daily-to-daily business. But because now these companies, they form one group, we have to do certain adjustment so that whatever need to be eliminated, we eliminate. Then whatever need to be brought into our books, we brought into our books. Then in that case, we are doing an adjustment. Then after doing the adjustment, now we're going to have a consolidated financial statement. So A Limited will draft its financial statement from its financial records, as does B Limited. And once the individual statements have been completed, the accountant used the information from these statements to make the necessary consolidation adjustment and only then compares the consolidated statements. Note that the original financial statement of A Limited and B Limited are never amended during the consolidation process. This process repeats itself after year, and the adjustments have to be made fresh every year. You will understand this better as you study the following learning units. Then our basic technique, which we're gonna use when we are doing the consolidations, is this one which presented to you. It will be the elimination of common items, the elimination of intra-group items, and then the last one, we're gonna do our consolidated remaining items. So the one which they didn't fall in elimination and they didn't fall in elimination of the common groups or intra-group. They are the one which they're gonna be presented in our consolidated financial statements. So we call them the consolidated items. So now let's tackle the one of eliminating common group. So elimination of a common group is whereby the owner's equity in the books of subsidiary and the investment in the parent, they are the one which they're going to be eliminated. So you find that I invested 10,000 and the 10,000 also the number of shares in my subsidiary. So this we call them common items. So these common items need to be eliminated. So let's check our study guide. They say one of the first adjustments the accountant should make to the consolidation statement is to eliminate the investment in the parent records and the owner's equity section in the subsidiary records as at the date when the investment was made. We do this because we need to eliminate all intergroup transactions since the group is regarded as one economic entity. So in this case, we are no longer recording two companies. We're no longer recording company A and company B. Instead, we did adjustment. Now we want to report one group being A group. Then we do this because we need to eliminate all intergroup transaction since the group is regarded as one economic entity and cannot enter into transaction within itself. So there's no way A can buy from B and B can buy from A. If that is happened, it needs to be eliminated so that we can able to report with anything that happened outside the group. Note, in this module, we only deal with the cases where the investment in the subsidiary is carried at the original cost price, which is assumed to be its fair value. For the sake of simplicity, it's assumed that the fair value remain unchanged from the original cost price. So now we have an example on page 14, whereby in our examples, we're gonna be illustrating the elimination of investment being our common items. As we check on our asset section from our pre-adjustment trial balance, we do have our investment in B Limited at a fair value. So we, as the A Limited, we invested 10,000 in B Limited. So we invested our 10,000, and again, we can see that the share capital of our B Limited as represented in the financial statement, if you can check on B Limited, their share capital for the 10,000 shares that we issued at R1, we have 10,000 rand. So these are the common items. They need to be eliminated as one of our first steps. So now we're going to draft the consolidated financial statement of the A Limited group on the 28th February 2005, while we assume that the A Limited acquired the interest in B Limited at the incorporation on the 28th February 2005. So today we assume that is the day that the company was incorporated, and then we're also going to do the reports on the financial year ending today. So first we're going to draft our pro forma consolidated journal, whereby we have a share capital of B Limited, which is 10,000, and then we have an investment in B Limited, which is to be 10,000. So the group consolidated statement of financial position will now be drafted as follows. So when we draft our financial statement, so since we eliminated the 10,000, the one for the investment and the one for the share capital, now we're going to have our cash and cash equivalents, which will be our 10,000 that we have on A Limited plus the 10,000 that we have in B Limited. So it means our cash and cash equivalents will be 10,000, and the share capital will be only 20,000, being the 20,000 of A Limited plus 0 of B Limited, because the 0 one is the one which was eliminated. Any question up to this point? I guess there's no question, then we can continue. Then on example 2, we still continue with the elimination of common items, whereby we've got A limited and also B limited, whereby investment in B limited at the fair value is equals 10,000 rand. And the share capital which was issued by B limited is also consisting of 10,000 rand. So these are the common items, they need to be eliminated. So the rest is the one which they're gonna remain. So when we draft our financial statement as shown in our page 16, we can see that we're gonna do a pro forma consolidated journal whereby we eliminate the 10,000 because it's our common item. We invested with 10,000 while the share capital was also 10,000. It need to be eliminated. So the one which is remaining there, the one which should be recorded in our financial statement. So we do our journal to eliminate the common item. Then after the elimination, we draft our consolidated financial statement. So we'll have our trade and other receivable, which will be the 12,000, the one we had on A limited, plus the 8,000 that we have on B limited. So our 12,000 plus 8, now we're gonna have our trade receivable of 20,000, and then we have cash and cash equivalents, the 14,000 from A plus the 10,000 from B. Then it's gonna be the 24,000, and then we have equities and the liabilities. It's gonna be the share capital, which in this case it's gonna be the 20,000 of A limited plus 0 being the one which was eliminated because it formed part of the common item. The 10,000, that 10,000 was eliminated. Then it means our share capital is going to remain at 20,000, and then retained earnings, which is going to be the 16,000 we have for A limited plus the 8,000 we have for B limited. Then we have our retained earnings totaling an amount of 24,000. So with reference to the previous 2 examples, we can deduce the following. 1, the journal entry for the elimination of the investment and the owner's equity at the date of acquisition will remain unchanged from 1 year to the next. And please note, every time when we'll be doing your consolidation financial statement, please don't forget to do the elimination of the common items. It's the first thing that need to be done before you can proceed with any other things. And the 2, the share capital of the consolidated statement of financial position is always only that of the parent. So since we have done the elimination, now our share capital is only gonna be the one of parent, because the one of the subsidiary is gone. It's no longer forming part of the group. And then the profits the subsidiary made after the date of acquisition become part of the retained earnings of the group and are shown as such in the consolidated statement. We will discuss this principle in greater in the line unit number 4. Because in that line unit number 4 is whereby we'll be dealing with the situation whereby the shares were acquired during the current year and B limited was still gonna continue doing the trade outside our business. So the profit which B limited will be earning is gonna form part of our group. So a certain percentage we need to get it from those profits, but we'll deal with that in the limit number 4. And then the profits the subsidiary made before the date of acquisition cannot form part of the retained earnings of the group. The parent pays for such profits will also take at the principal in limit number 4. And since the parent obtained interest in the subsidiary at the date of incorporation, the date on which the company was established, there could not have been any retained earnings in the record of B limited. So since in this case, the company was formed today and then we also obtained it today, there is no retained earnings in the prior year. So we're not going to disclose any retained earnings. But if we had a situation whereby the company was formed maybe 2 years ago and we obtained it today, so there were going to be a retained earnings from the prior years. So that retained earnings from the prior year is need to be disclosed in our financial statement, but that one you can also show it when we'll be dealing with line number 4. Now, the second part, it will be the elimination of intra-group items. In this case, there will be certain transactions which will be taking place. So as a result of those transactions taking place, those transactions at the end, because the transactions that are taking place within the company or within the group, so that all the transactions that is taking place within the group, they need to be eliminated. From our diagram, we have on the 2.2, we have a diagram whereby we've got a company A and a company B, whereby they tell us that company A, it deals with the selling of timber to the public. And while company B is dealing with the selling of wooden wagons to the public. So in this case, we have a situation whereby our company A sell a machine to a company B. And on the other side, we have a situation whereby company A also sells timber to company B, or company B also sell timber to company A. So because normally when I sell timber to the public, I'm going to generate a profit of certain percentage. So in this case, I'm going to also sell timber to A Limited. And by doing so, I will sell them at the same market price which I charge to the public. So I'm going to also get a profit from that sale. So, but since me as B group, me as B Limited, I'm forming part of A group. So the profit that I'm going to realize from the sales I made to A Limited must not form part of the group, must be eliminated, because it's the profit within the group. So you can't have a profit within the group. If there's a profit within the group, that profit needs to be eliminated. We only focus on the profit made outside the group. Is the one which is going to form part of our financial statement. But any profit that we're going to realize within the group, it needs to be eliminated. So the actual profit the group made from the sale of goods was the profit made from the sales to the public only. Since all other sales took place within the group, sales within the group are known as intergroup sales. Therefore, they have to be eliminated during the consolidations. A Limited may lend a sum of money or sell an asset to B Limited. We will also have to eliminate this transaction. So this part of the transaction, it will be more dealt with in the land use number 7. So is there anyone who have a question with regard to the elimination of intergroup items? Ms. Kodibo? Yes, Kodibo, you can answer. I mean, you can ask the question. Kodibo, your hand is up. Okay, is there any other one who want to ask a question? I will assume that no one want to ask a question. We can proceed. Then
Sorry,
you were
you
were on mute. Okay.
Yeah.
I can hear you now.
Okay, how are you?
I'm fine, thanks. And you?
I'm good. When we eliminate, are we eliminating in form of general journal?
Yes, the eliminations they are done in the form of general journal. So as our basic principle of doing the consolidation statement, first we're gonna do the elimination. So when they say do in exam, they will say they're gonna present the pre-adjustment trial balance, and then from there they say draft the consolidated statement of financial position for the year ended, blah blah blah, and then they say 50 marks. So you, by reading all the scenario, you will see that they will have an intra-company transaction. So you have to eliminate them. So their elimination will be done in the form of journal. So journal will be your first step to draft the financial statement at the end. So you're gonna do the journal, you eliminate whatever needs to be eliminated. So whatever remain then is the one which is gonna be used for doing the financial statement. So it go back to here. So these are the basic techniques that you're gonna do. You eliminate the common item. So whatever is remaining is the one which needs to be used to present your financial statement, the consolidated one.
Okay, it makes sense. And then like we do it in form of reversal, like I mean in a way of reversal, like
yes,
reversing
I'm canceling whatever happened. So I'm reversing. Yes, it's in the form of reversal.
Okay, thank you so much.
Okay, thank you. Another one, is there anyone who want to ask a question with regards to the elimination of intra-group or the elimination of common item before we move further to the next part? I don't see any hand, so I can assume that everyone is fine. We can proceed further. So So the last part, it will be the consolidating of the remaining items. So since we eliminated our common item and we also eliminated our intergroup items, so whatever remain is the one which they're gonna fall into our consolidated financial statement. So if you can take further, we go to our page 18. So now from the page 70, we start with the consolidating the remaining items. So once we have eliminated all the common group, the common and intra-group item, we can draw up the consolidated statement of financial position, the consolidated statement of profit and loss, and other comprehensive income, together with the consolidated statement of changes in equity and the consolidated statement of cash flow. In this module, we expect you to be able to do all the relevant pro forma consolidation journal entries for the consolidation purposes, and to draft the consolidated statement of financial position, statement of profit and loss, and changes in equity. So the consolidated statement of the financial position of a wholly owned subsidiary at the date of acquisition. So here we have a situation whereby I acquire the asset in B Limited, and then we have to draft the consolidated statement of financial position, whereby me as A Limited, I'm owning the whole interest in B Limited. So in this case, it means I'm owning 100%. So the first thing that we're gonna do is we have to account for all business combination on the purchase or the acquisition method. And this method involves the following 4 steps. 1, we identify the acquirer, we determine the acquisition date. That one is important. Please make sure that every time when you read your question, you have to note when was this acquisition date made, so that it can able to give you a time frame. How are you gonna draft your financial statement, so that you know that your financial statement they're gonna start from the current year, or they have to go back to the prior year, whereby you're gonna have the, in terms of you doing your analysis of shareholders, you're gonna see it when you're doing the limit number 4. You're gonna have the since acquisition up to the current year, and then from there you have the current year. The current year will be the year we are reporting on. But since acquisition until the beginning of the current year, it will be from the beginning where we acquired the interest in B Limited up to the beginning of our current year. So it's important to note the date where we acquired the asset, the shares in B Limited. Then the next one, it will be the recognizing and measuring the identifiable assets acquired, the liabilities assumed, and any non-controlling interest in the acquiree. Then the last one will be the recognizing and measuring goodwill or gain from the bargain purchase. The following 3 situations may arise if a parent obtained an interest in a subsidiary. 1, the price paid by the parent for the interest or investment in a subsidiary is equivalent to the fair value of the assets and liabilities. So in this case, this one will be calling it a net asset value. So when we are doing the consolidations, it's either you can acquire them at the net asset value or you can acquire them at a premium. So the acquisition of a premium is whereby the price paid by the parent for the interest is higher than the fair value of the assets and the liabilities acquired. This will be known as the acquisition at a premium. So it means I invested more than what was worth in company B Limited. So in this case, we acquired those assets with a premium. So if I invested what is equal to the fair value of the shareholders of the subsidiary, so it means I acquired them at the net asset value. So after the initial recognition, the parent must measure the goodwill acquired in a business combination at cost less any accumulated impairment losses. We do not amortize goodwill. Instead, the parent must test it for impairment annually or more frequently in events or changes in circumstance indicate that it might be impaired in accordance with IS 36 impairment of assets. In this module, we will not be dealing with the impairment losses, but we will assume that the initial cost price of the goodwill to be equal to the current fair value. The price paid by the parent is lower than the fair value of assets and liabilities acquired. This is known as the acquisition of a subsidiary at a discount, which is also referred to as the gain from the bargain purchase and is recognized at the acquisition date in a profit or loss. For the purpose of this module, note that the gain from a bargain purchase is possibility when acquiring a subsidiary. However, we'll deal with in the third year modules. So for the purpose of this module, we're not going to deal with the situation whereby the parent acquired the asset at the lower fair value. So in this case, it will be either at equal or higher. So now the following examples illustrate the possible situation that may arise, which they will be dealing with the one of the net asset value or the one whereby we acquired at a premium. For the purpose of example 1 on page 19, this one we acquired the asset at the net asset value. So we've got a pre-adjustment trial balance whereby we've got A limited and B limited. And then from the statement, they tell us that the following represent the applicable statement of financial position for of A limited and its wholly owned subsidiary B limited at 31 December 2005. So this statement is for 31 December 2005, which is the date on which A limited acquires its interest in B limited. So we acquired our interest in B limited on 31 December. As I mentioned, that you must know the date where the acquisition was made. So in this case, the acquisition was made at the end of the current year. So investment in B limited consists of 90,000, and then the bank for A and B is 30 and 55. The trade receivable is 60 and 35, and then equity and liabilities, the share capital, ordinary shares at 100 divided by 50. 150. The 100 is the one for A limited, and the 50 will be the one for B limited. Then the retained earnings for both group, it will be 80,000 for A and 40,000 for B. Now we're going to go to the solution. Remember, here we are dealing with a situation whereby the acquisition was made at net asset value. So it meaning the amount that we paid for investment, it will be equal to the fair value of the asset and the liabilities of our subsidiary. So now we have a share capital. Remember, our analysis of shareholders, we are dealing with the B parent, the B as a subsidiary. So the analysis of shareholders of B limited, it will be the share capital. So the share capital, it was 50,000. So on the total side, we put 50,000. And then at acquisition, we put 100,000. So we put 50,000. So in order to put the 50,000, we said this was the wholly owned subsidiary. So to determine whether it's a wholly owned subsidiary or it's a partly owned subsidiary, you're gonna say the acquisition made, which it was the shares invested. We have the shares to the value of 50, which is the one for B limited, and then the ordinary shares in A limited is valued at 100,000. So when we say the 50 divided by 100, it will be 50. But when you say the 100 divided by 100, then it will be the 100%. So our 100% came as a result of, let's see, investment 90. Okay, our wholly owned subsidiary, it came as a result of the total number that we invested. It is equal to what is the fair value in the group. So we own them at 100%. So our share capital is 50, and then at 100% on the at acquisition part, it will also be 50. Then the retained earnings of B limited is 40, and then at acquisition, which is the date that we acquire, which is we acquire them at 100%, it will also remain 40. Then when we add the two together, it will be 90. Then the purchase difference, we don't have with that one, it is represented by the goodwill. So we paid an amount of 90,000, which is total to the net value of their equity on B limited. So we paid 90,000 as our investment, and then their fair value of the share capital, the 50 plus the retained earnings, the fair value of their equity is equal to 90. So in this case, it means we acquired the asset at net asset value. So we don't have any purchase difference or goodwill. So in this case, our goodwill will remain at 0. Therefore, it is clear that the price A limited paid for the investment in B limited equal to the net asset acquired, being 90,000. So the 50,000 of the share capital plus the 50,000 of the retained earnings we had in B limited, they will equal the 90,000. So at this stage, so it means we have the the consideration paid at 90,000 with the fair value of the equity at 90,000. Then for the pro forma journal, whereby we're gonna eliminate our intergroup. So we have to eliminate that 90,000, the one for the share capital plus the one for retained earnings. They need to be eliminated because they will be regarded as the common item. Then we do the reversal at the end. So the investment in B Limited will be 90,000, which will be credited, and the share capital and the retained earnings of B Limited will be 50/40 and will be debited. The price paid by A Limited for the investment in B Limited equal to the value of the net asset acquired, which is 90, and 50 plus 40 equal the 90. So now we're going to draft the consolidated financial statement. So since we eliminated the share capital and the retained earnings of B Limited, we're going to draft the consolidations for what left, which the 90,000 for the share capital and the retained earnings was eliminated, together with the 90,000 for the investment was eliminated. So whatever left need to be drafted, need to be consolidated in our books. We have cash and cash equivalents for A Limited, which is 30, and the one for B Limited was 55. Then when you add them all together, it will be 85,000. Then we have a trade and other receivable for A Limited, which was 60, and the one for B Limited was 35. Then when we add them all together, they're equivalent to 95,000. Then our total asset will be represented by the amount of 180,000. Then we go to the equity and the liabilities. The equity attributable to the owners of the parent, the share capital, we're going to focus only on the share capital of the parent company, which will be 100,000. And then the retained earnings, we're also going to focus on the retained earnings of the parent company being the 80,000, because the one for subsidiary, they have been eliminated as our common items. So we can see that our statement of financial position balance, the 180 on the asset side plus the 180 on the equity and the liability side. Now we go to example 2. In example 2 is whereby, example 2, page 20, is whereby the acquisition of a subsidiary is made at a premium. So in this case, the amount that we paid to acquire the shares in B Limited, we paid higher amount than what was worth by the shares and the equities of B Limited. So let's see how this example looks. The following represent the average statement of financial position of A Limited and its wholly owned subsidiary B Limited as the 31 December 2005. This is also the date on which A Limited acquired its interest in B Limited. Note that the information is in the same as in the previous example, except for the investment, which is now 100,000 instead of 90,000. So investment in B Limited at fair value equal 100,000. The bank 2055, trade and other receivable 6055, 35, and then equity and liabilities. The share capital ordinary shares is 100,000 and 50,000. Then the retained earnings is 80 and 40. So now we have to do our solution. So in our solution, we're going to determine the analysis of shareholders' equity of the B Limited, which is a subsidiary. We had the share capital in a subsidiary, which is 50,000. And then we have a retained earnings, which was 40,000. And then at acquisition, we have 50,000 because it's the wholly owned subsidiary. And then we have our retained earnings as 40,000. Then when we add the two, they're going to give us a total of 90,000 on total, together with also on at acquisition. Then the equity represented by the goodwill, that one we're going to show it at the later stage. So the consideration which we paid is 100,000. So the consideration paid of 100,000 less what was worth in the books of B Limited, which it was 90,000. So we have a difference of 10,000. So that represents our goodwill, because it's the difference between the sale versus the amount that we bought with. So in this case, the 10,000 is formed like it's a profit, but we're not gonna realize it. We're not gonna generalize it as a profit. Instead, we represent it as a goodwill that the company was performing well. So this is become a gesture. So this it will represent by the goodwill. So which a goodwill is gonna be regarded as an asset. From there, we do our pro forma consolidated journal, whereby we're going to eliminate the common items. So we have a share capital of 50,000 for B Limited. We have retained earnings of 40,000 for B Limited. And then we have a goodwill, which was generated as a result of acquiring the asset at premium, which the goodwill that we had is 10,000. So investment which was made by A Limited to B Limited is 100,000. So in this case, is the eliminate. We do the reversal, which will be the elimination of the common items. From after the elimination, then we're gonna draft our consolidated financial statement. So since we did the elimination, so on the non-current assets, we're gonna have a goodwill, which will be 10,000, is the one which we realized it. And then on the current assets, we're gonna have cash and cash equivalents, which will be 20 plus 55 is 75. The trade and other receivable, which it will be 60 plus 35, which would be 95. Then when we add the 10,000 plus the 170, then they give us the total assets of 180. Then we're gonna go to our equity and the liabilities, whereby we'll have a share capital of the 100,000, which this will be the share capital of the A Limited as the parent company, and the retained earnings of 80,000 being the 80,000 from the parent company. So when we add them, the two, they're gonna be 180,000. So the comments from the previous example, it says in this example, the parent paid more than the net asset value of its interest in the subsidiary, which means that the premium goodwill was paid at acquisition. Goodwill is regarded as an intangible asset and should be shown as a non-current asset in the consolidated statement of financial position. In this module, we determine the goodwill at acquisition only. We are not concerned with the future changes in the value of goodwill, which will be dealt more in the third year. Then according to the IFRS 3, the two options for calculating the goodwill are as follows: the partial method, the method used in this study guide, and the full goodwill method, which is used the non-controlling interest at the fair value to determine the goodwill. So that method, it will be dealt more on that level. So the last one, the acquisition of a subsidiary at a discount, which is the one which I mentioned earlier, that in this case, we are not dealing with any method whereby we acquired the books of the subsidiary at a discount. That one, it will be dealt more in the third level. Up to this point, is there anyone who have a question that we'll need to ask? I can assume that there is no. Okay. Jimmy-san, you want to ask a question?
Yes, good morning, everyone. Just if possible, are you able to provide us with examples that are not showing? You see those share capitals showing 50,000 each, which are more realistic, so we can be able to tell the difference as to how we tackle it. The more practical examples, because all of these with share capitals with 50,000 are a bit confusing because you don't know what is which, how to get which amount to where and where to place it. I don't know if I make sense.
So you get confused by the 50,000 shares versus the 50,000 capital on the B Limited.
That's correct, yes.
So you wanted a situation maybe whereby we are having, let's say 50,000 shares, but maybe the price on the B Limited is maybe 125 or 150.
That's correct, yes.
Okay. Let's have a look if I can find any one of the example. Just hold on. Because in this case, the reason they use the 50 and the 50 is because their shares, they were traded at 1 rand. We didn't have a situation whereby the shares were traded at 2 rand or 2 rand 50. In most cases in this study, they just use the cases where the shares are acquired at 1 rand. I haven't encountered one whereby the shares will be at 2 rand or more. Okay, let's say on the same example, page we want us to focus on which one? The one whereby the shares were acquired at a premium or at the net value. Jumisang?
The premium will be a much more, I would assume, a challenging example. So let's rather go with the premium example.
Okay. Let's say from page 20, right? We're going to use the same example on page 20 though. Let's say our share capital on the ordinary shares, right? Let's say now the shares are traded at 2 rand. Ne? So in this case, the 100,000 number of shares in our A limited rent values, it's gonna be represented as the 200,000. And then the 50,000 number of shares in B limited will be represented as 100,000 shares. So when you do your elimination, so it means on the other side, our fair value also need to be changed from the 100 to almost it will be around 150. The cost price of the A limited is gonna change from 100 to 150. So let me try to do it in the form of Excel. Allow me to, while I'm opening an Excel so that we can do it all together. On your side, do you see the Excel screen? Because I can't able to trace if you're seeing the Excel screen or not.
No, it's not showing as
You
yet.
still see the slide one.
That's correct. Yeah, I'm seeing the
Okay.
slide.
Okay, just hold on. You see the Excel now. Now.
Yes, I can see the slides. I don't know about the others.
You still see
I can see the Excel, sorry.
Okay. Let's focus on the same example on page 21, whereby the acquisition. We're gonna say investment in B. Now it will change to 150. Let's assume it's 150. And then the bank will remain the same as 2055. And then we're gonna only change few things so that we can able to understand maybe. So this one will be 150. And then our bank, it will remain at 2055, trade and other receivables 6055. And then the share capital, ordinary shares. The share capital will have the ordinary shares be for 100,000 at 2 rand in A limited. Which it will be an amount of 200, right?
That's correct, yeah.
And then on our, this one will be A limited. And this one will be B limited. So on our B limited, we have the they acquired 50,000, which it will be at 2 rand. So we'll say 50,000 shares at 2 rand,
which is 100,000.
100,000, and then the retained earnings, let's remain it same at 80/40. So now let's do our analysis of share of the owner's equity. So your conviction is where is more on the analysis or is more on the consolidations?
It's the analysis, yes.
Okay.
The analysis, yeah.
Let's go to the analysis. We'll have a total. We have add acquisition. And then the last one will be since, which we don't have at this moment. Then our share capital, remember now we are doing the analysis of shareholders of B Limited, right? Share capital. So our share capital in B Limited now, it's gonna be, okay, so I didn't mention something here. Okay, the one for B Limited should be sitting here as 100. So our share capital, the total now, it's gonna be 100, right? You get it?
Correct, yeah.
Like then add acquisition, because since they wholly owned, it's still gonna remain at 100. However, the shares we acquired in terms of number of shares is 50. Remember the shares is 50, but the value they equal the 100. You get it?
Okay, no problem.
That case it was 50/50. That's why you were confused why they using 50/50. So the number of shares still remain at 50. However, the value in these shares is 100. Does it clear now?
Yes, it is clear. Thanks.
So now we're using this 100. This one is the one which is gonna place it here. That one, not this 50. So here we focus on the rent side.
Okay.
Yeah, so it's not focusing on the number, because if you can see, I think I get why you were confused, because it's 100. So you don't know is the 100 as number or is 100 as the value. So here we focus on the value side.
Okay. Okay, now it makes sense.
Is it clear now? So
yes.
The same value is the one which you're gonna use to do your elimination journals.
Okay. No,
yes.
I do understand now. Thanks.
Oh, okay. Anyone who have the question with regard to these consolidations? Okay, we can continue. So we have dealt with our example, which it was example 1 and example 2, whereby the shares were acquired at net value, and the other one were acquired at a premium. Now we've got 2 questions from page 23. Page 23 and 24, it will be dealing with the question. So let's go through those questions again. We've got question 1, whereby on 2.4, they say to see whether you are able to apply the content miscellaneous unit, answer the following question. Your e-tutor can guide you through the completion of this question. It is important to calculate the answers before taking the suggested solution. So we've got the question whereby they say the statement of financial position at 30 June 2006 for P Limited and S Limited. So they don't mention anything about the acquisition, but we will assume that the acquisition was made on, or they did mention at the required part. They say draft the consolidated statement of financial position of P Limited Group as at 30 June in compliance with IFRS if P Limited acquired interest in S Limited on 30 June, which is the same date that we acquired our asset. So our asset in S Limited, it consists of 100,000 number of shares, and then where the cost price equal to 145, and the share capital or the current asset equal to 40,000 and 115, and the equity and the liabilities, the share capital is 100,000 ordinary shares, and the retained earnings is 85,000 and 15,000. So I want to ask a question from you guys. Do you want me to do this question in the form of Excel while I'm getting guidance from you, or you just want me to go straight to the solution, then we tackle the solution while looking at the solution, and then we interact with the solution?
I think the form of Excel is more interesting. It gives a clear clarification.
Okay. That was me.
Tackle the solution. I
Mr.
think that's to tackle the solution. I think it's much easier. Like, yeah, for me.
I think Excel will give us a much more practical how to do it. So Excel, I would go with Excel.
Let's try the one of Excel first and see. Then we'll. Okay,
Mr.
Yeah, Bo.
Yeah, I mean, I have a suggestion. It depends on your time, like how much time do you have on hand, because Excel will waste time if you don't have enough time. But if you have enough time, we can try to use an example. I don't know, it's just my suggestion as well.
The first one, let me do using the Excel, and then I'm not gonna cover the whole part, but I'm gonna just the basic things that need to be done first. There are the certain basics that need to be tackled, and then the remaining they're just on the solution itself. Then the second one, we're gonna just do straight from the solution.
Okay, noted. Thank you.
Okay, let me share the Excel part in the meantime. In this case, now we're gonna tackle the question on question 1. From page 23. Okay, so in this case, they presented everything. Now the only thing that we need to do is to start drafting our consolidations. So there are basic steps that we need to follow. So which it will be the elimination of the common item, and then the elimination of intra-group, and then the last one will be drafting the consolidations. So 1 will be elimination. And then 2, elimination of the and then lastly in the consolidation. So these are the basic things that you need to do. Every time when you'll be answering your question, though, you have to follow that principle. So from there, and then while you are drafting the consolidations, you have to now calculate the interest in order to know whether it's a wholly owned subsidiary or not wholly owned subsidiary. To know if it's a wholly owned, so the formula that you use is gonna be investment in S in subsidiary. And then you divide it by the number of shares issued. Divide by the ordinary shares issued in subsidiary. And then you may multiply by 100. So in this case, when we check our example, the investment made in subsidiary, we made an investment of how much? The one which we paid. I'm waiting for answer from you.
We made investment of is which example? Is it page? Is the one that we're doing?
It's the example from page 23.
Oh, page 23. Oh, we invested
It is 145,000.
We invested 145,000.
Mm.
And then the ordinary shares in S Limited.
100,000.
It's 100,000. So as far as we invested 145, so this is the wholly owned, because the value that we invested is already higher than what the person is owing on his books. You get it?
Mm.
So in this case, now they say we've got investment in S Limited is 100,000 shares, share capital 100, ordinary shares 100. And then the ordinary shares of S Limited is 100,000 shares. So you see our investment, if you can check on the asset section of the pre-adjustment trial balance, they say investment in S Limited consists of 100,000 shares, right? At fair value of 145. So we don't know at what price is this shares. Maybe it means the price of the shares is 145 cents. So the number of shares that we invested in that particular book is 100,000. So we own them, the full 100,000 shares. So it means in this case, it's going to be a wholly owned subsidiary. Therefore, we own 100%. So it means it's going to be 100 as the number of shares in A Limited. The 100,000 shares in A Limited. In B Limited. And then divided by the 100,000.
What do you say?
The 100,000 investment, we invested with the value
It's actually P Limited and
P
S Limited,
Yeah,
not B Limited.
Oh, yes.
sorry, is in P Limited. Here should be P Limited, right? Ne? So it's okay that in this case. Are we all together?
Yes.
Okay. So in this case, now is a wholly owned subsidiary. Therefore, now we can proceed further, whereby we're going to draft the analysis of shareholders of this group. Then we've got total. We have at acquisition. And then the last one will be the scenes, which we don't have that one. The scenes will come when we'll be dealing with line unit number 4, whereby the date which we acquire the assets different to our financial year. So the share capital of billing of our subsidiary, which is S Limited. We have the share capital of how much?
100,000.
100. And then at acquisition. Then at acquisition, since it's the wholly owned subsidiary, at our acquisition, it's gonna also remain at 100.
La? Uncle?
Please mute.
Kulum?
So at acquisition, it will be 100,000 also. Then our retained earnings from our book of our retained earnings from the books of our S Limited, it will be how much?
15,000.
15,000. So it's 15. And since it's a wholly owned, it's gonna also be 15. Then we can add this all together being 115. And then here to also be 115. Then from there, we check the payment, the consideration made by our parent company, which is P. So the consideration paid, this will be total. And consideration paid. The consideration paid is how much? We paid an amount of 145, right? Then
That would be 145 less 115. Is that correct?
Yes.
And it gives us 30,000.
So our 30,000 will represent the goodwill. So this 30,000 here, it will be our goodwill, which is gonna be part of our asset in our consolidated financial statement. So this will represent the goodwill. Then when we do we're gonna from now, since we did this analysis of shareholders, then we have to eliminate our common items. So our elimination, it will be as follows. So since we are doing the reversal, normally we know that when we do journal, so this will be regarded as a pro forma journal. So when we do our journal, credit. So normally we know that in most cases, our share capital, it goes on the credit side, right? So in this case, since we are doing the elimination, we're gonna do a reversal. So like there is one student who mentioned that this will be a reversal. So whatever needs to use to go into the debit side, now it's gonna go into the credit. And whatever I used to go into the credit side, now it's going to go to the debit because we are doing the reversal. So in this case, we're going to eliminate our share capital. The one for our subsidiary being S Limited. So the elimination, our share capital of our subsidiary, initially it was sitting as 100,000, right? So since it was used to go into the credit, now it's gonna come into the debit side. And then we have the retained earnings, which is also used to go into the credit side. Now it's gonna come to the debit side. So the retained earnings will be sitting at our retained earnings was how much? 15. Therefore, the last thing that needs to be done is the goodwill. Which we calculated as 30,000. Then investment in subsidiary. Now it's gonna go into the credit side as the total that we invested with in rent value as 145. So we don't say investment is 100,000, it's 145 using the rent value, not the number of shares that we invested or the number of shares that you acquired in the books of S Limited. So the narration will be the elimination of the common items at the acquisition. So up to so far, are we fine with this part?
Sorry, sir, can I ask a question?
Mm-hmm.
When you were debiting the share capital, you explained that it used to go on a credit side. Now we are debiting and also retained earnings. But with goodwill, isn't it an asset? It was supposed to be debited. When you are reversing, it's going to be a credit.
Yeah, the goodwill is not reversed. The reason being is something that created while we are doing the consolidations. So this thing, it was created. It came when we are doing this the consolidation. Yes, it was created. So remember, we're gonna carry it over because when we draft our when we draft our thing, our consolidated statement of financial position, we have to carry it over that goodwill of 30,000. So it's not gone. We don't erase it.
Oh, I see. Okay.
You get it now?
Yes.
It makes sense.
Yes.
Okay. So now this is the elimination of the intergroup item, but the goodwill, since it was created during the consolidations, it created because of we buying. If we were not buying, we're not gonna have a goodwill. So we're gonna only eliminate the 150 done. But because we bought more than what was worth, so we are the one created that goodwill. So since we created it, we have to carry it over into our books. So from there, we're gonna do our our consolidated thingies, statement of financial position, SFP. Then we're gonna have the total assets, the asset section. Which we're gonna have the non-current assets, which will be represented by the goodwill. So our goodwill will be the 30,000. And then we have our current assets. And the current assets as given from the question 1, they didn't categorize them that which one is which. They just give the total of 40 plus 115. So it will be the 40 from the parent company plus 115 from the subsidiary.
Hi, sir.
Yeah, boy.
Yes, can I ask a question in non-current assets? I want to know that, yes, we are not supposed to include the investment there. Can you please explain for me?
The investment is not, we're not going to include it. Why? It's always, it is here, it's eliminated. Remember, this is the elimination, this part.
Okay.
We in the beginning, subsidiary have 100,000 shares and have a retained earnings of 15,000. Then we, as the parent, we decided to buy our subsidiary. Instead of buying our subsidiary to the value of 115, we decided to buy with 145 because we assumed that this was the good company. It used to operate well in the market. So we said this company that we are acquiring, it have a value. So we bought with 145,000, which we created the value of that particular company. So this investment, we eliminate it. It's no longer forming part of our consolidations. However, the goodwill, it's gonna form part of the consolidations because we are the one created it. It was not there. We created the goodwill because we said this is the good company, it have a good reputation. So we also buy that reputation, knowing that if we bought that company, it's gonna also generate more profit on our side as the group, because people, they will also go in there to buy in that particular company, not knowing that now they are buying from me. I don't know if you get it. For example, if there is a person who is the favorite of True Words, but because now it's forming part of the TFG, we bought the legacy of the True Words. So that legacy of the True Words is represented by this 30,000 rand.
Yes.
So the person will be going to buy the True Words, but not knowing that by buying at the True Words, you are also bought at Total Sport somewhere, somehow. Because Total Sport, True Words, and Markhams, they are forming one group, being TFG. So when we report, we're not going to report the profit of the Total Sport or the profit of Markhams. Instead, we're going to report the profit of TFG as a whole.
Oh, okay.
It makes sense.
Yes, it makes sense now. Thank you.
Okay.
All right.
So now our non-current asset will be the goodwill of 30,000. However, the investment of 145, it falls away because it now exchanged by the 30,000 of the legacy of all other different companies. Then we have our current asset, which will be the one for Group A and the one for Group B, which it was 40 plus 115. Then our current asset will be represented by an amount of 155. So now we're gonna have the total asset. Our total asset will be represented by which it will be 185. Now we're gonna go to the equity side. We've got the share capital. Then now we're gonna focus on the share capital of the parent because the subsidiary was eliminated here. We eliminate everything for subsidiary in this portion. So we are no longer forming part, we are no longer focusing on the share capital of the subsidiary. We only focus on the share capital of parent. So our share capital of the parent in our books is how much? Is represented by an amount of 100,000. So it will be the 100,000 plus 0, because 0 is the one which is eliminated. And it means we will remain on the 100,000. And then the retained earnings, it will be
Sir,
mhm.
I'm lost in current assets. I don't know where do you get this 40,000.
The 40,000.
Yes, for current assets.
If you can go to the current assets on, we are doing the example. We are doing the question 1, right?
Oh,
On
okay. No, I
on
see.
page
I see
23.
it.
I don't know which
Oh.
page are you
No.
on your side.
I see it now. Thanks.
Okay.
All right.
Then the retained earnings, it will be 85, the one for our parent. 5 plus the 0, because the 15,000 was eliminated. You see that 15,000 was eliminated, so it will be plus 0. Then we'll have the total of the same 85,000. Then when we add the 2, they're gonna give us total equity and liabilities of 185. Which will be 185. So up to this point, anyone who have a question with regard to the consolidations, the drafting of the consolidated financial statement, whereby is the wholly owned subsidiary and the acquisition was made at the same date where the financial statement have been reported. Anyone who have a question there? None. Okay, we can proceed further to question 2. The question 2, which is found on page 24. We've got the share, we've got the abridged statement of financial position, which is a trial balance. The share capital being for P Limited is 100, and then for S Limited is 50, and then the retained earnings is 80-20, trade and other receivable 40-15, inventories 20-35. Then we've got trade and other payables of 15 and 18, long-term borrowing of 100. The loan in S Limited, investment in S Limited at 50,000 shares at fair value, which is 80. The cost price is 80 rand also. Loan to P Bank, 80. Bank, 25 and 58. Then the property, plant and equipment is 50 and 60. So from our basic principle that we do when we draft our financial statement, it will be the elimination of the common item, the elimination of intergroup, and then from there we do our pre-adjustment, we do our consolidations. So when we do our consolidation is where we're gonna have the step 1, which will be the determining the percentage. Step 2, you draft the analysis of shareholders, and then from there you eliminate. Then we calculate the percentage in interest. So it's gonna be the investment in S Limited divided by the ordinary shares of S Limited, which is equals to the 100,000 shares investment that we have in S Limited. Investment in S Limited is 50,000 shares at fair value, and then the share capital is ordinary shares of 100,000, which in P Limited is 100,000 number of shares plus the 100,000 value. So if you can see, we have the 100,000 number of shares in P Limited that were issued. And then on the S Limited, the number of shares which they were issued, it was 50,000 shares. So since we acquired, if you can check the investment in S Limited on your pre-adjustment trial balance, they said we as the parent, we invested 50,000 shares at fair value, and the price equaled how much? They equaled the value of 80,000 rand. So it means when we determine our percentage, it will be like this termination of percentage. It will be the investment in S Limited. Whereby we invested with how much? The 50,000. If you can check on your question 2, they say investment in S Limited is 50,000 shares at fair value, and their price of that 50,000 shares equal 80,000 rand. So here it will be 50,000, which is the number of shares we invested on the subsidiary. And then the ordinary shares issued by S Limited. So it's also on the S Limited. If you check from their pre-adjustment trial balance, they tell us that the share capital in ordinary shares for S Limited is 50,000 shares, and the value is also 50,000 in rand. So it means it's 50,000 shares issued at 1 rand. That's why it's called to the 50,000 in value. So the number of shares issued by S Limited is also 50,000. So as a result, since we acquired 50,000 shares in S Limited, while S Limited also issued 50,000 shares. Therefore, it means we are owning 100%. I guess it makes sense there. Then the total will be 100%. So we own 100% value in S Limited. Know that the interest in S Limited is determined by the amount shares held in S Limited and not the rent value. So we focus on the number of shares, not the value that we have. So you must use the 100 shares and not 145. Anyone who want to ask a question? Any question? Okay. And then now, step 2, we're going to draft the analysis of shareholders in equity of S Limited. So the share capital will be 100. The retained earnings will also be 15, which is the one which is represented in the books of S Limited. Sorry, I'm on the wrong solution. Okay, on the step 2, we're drafting the analysis of equity of S Limited. So we have share capital, which it was 50, as shown in the pre-adjustment trial balance on page 24, is 50. And then the retained earnings is 20, as also shown in the books of pre-adjustment trial balance. So we have total of 70 being the total, whereby we are adding the 50,000 from the share capital plus the 20,000 from the retained earnings, then it will be 17. Then our equity represented by the goodwill, let's say we don't know it yet, just put it as a question mark. Then the consideration we paid for the value of 70,000, which it was worth from the books of S Limited, we as P Limited, we decided to pay an amount of how much? 80,000 as the investment in value. So our investment in value is 80,000. So our 80,000 less the 70,000 worth from the books of S Limited, then we have a bargain, or we have a difference in purchase price of 10,000. So that 10,000 will represent the goodwill. Are we in the same page? I assume that we are in the same page. Then from there, we created a goodwill of 10,000. Then after that creation of the goodwill of 10,000, now we're gonna do the elimination of the common items. So our elimination, if you can check from the trial balance, there was a loan made by S Limited. S Limited had a loan of 80,000, which it means it will be the loan received from on the books of the P Limited. We're gonna have the loan received from S being 80,000, which is gonna form the asset. And then on the book of S, we have a liability part whereby there is a loan to P Limited, which is the amount of 80,000, which was paid. So this 80,000 is the common item. They need to be eliminated. So we're gonna eliminate those two items. So the loan to P Limited, which normally it came as a income or an asset on our side. Now we're gonna eliminate it. So we're gonna say loan to P Limited is 80,000, then loan to S Limited, which is 80,000. So we eliminate those two common items. Are we fine there? Are we clear on the elimination of loans?
Sorry, sir.
Yes, yes.
Okay.
Sorry.
And then,
Sorry.
yeah, bo.
So you said the loan to P, it's an asset.
Okay, the loan to the loan was offered by let's see, the loan investment in loan to S Limited. So here we as the parent company, we made loan to S Limited. So in this case, when we made a loan to S Limited, so S Limited need to pay us at the end, right?
Yes.
And then if S Limited need to pay us at the end, so when we do our books, it's gonna be recorded on which side when we do our books alone, this loan. Between the debit and the credit, where are we gonna record it?
No, I'm not sure.
You're not sure?
Oh.
Remember, I'm having, here is me, I'm giving you the money. So I'm not receiving it, I'm giving you. So it means on the other side, you're gonna end up owing me. So
yes.
It's a liability on my side. So the liability on my side, when I have to record it, it's a loan. So we have to open the book of the trial balance. I'm not the trial balance, the ledger part. So on the credit loan, so the loan, they increase it on which side? In most cases, we go back to our accounting one. I guess that one you can answer. Unless it's pass and forget. So they increase on the credit side, right? So yes. On the credit side, when you open our loan account, so you're gonna have a loan to S Limited, which it will be on the credit side. So for an amount of 80,000. So because now you are reversing it, you're gonna say loan that you made, which is it made by who? You as the P book. You're gonna reverse it and you record it on the debit side.
Yes.
It makes sense there.
Yes.
Okay. And then on the other side, whereby they say the loan S Limited is the amount which they received as S Limited. They received an amount of 80,000. So now they have to reverse it back. So when they reverse it, they cancel it. It was initially recorded on their side as an asset because they received it. Now they have to reverse it back on the credit side.
Yes.
It makes sense.
Yes.
So it's important to show those things of the P Limited and the S Limited when you are drafting your elimination. Don't just say loan and 80,000 and another loan of 80,000 without showing us which one is P, which one is S. Because if you just say loan and then you put S Limited on your debit side, it means you are not reversing instead. You just accounting it as if it is still happening now.
Yeah.
Yeah. Then from there, you eliminate your loans, the intra-group loans. From there, now you're going to record the share capital. So we had the share capital, which was represented by the 50 and the 20. 50 for share capital and the 20 for retained earnings, while we had also had an investment of how much? Investment of 100,000. So you need to eliminate, investment of 80,000. So you need to eliminate those things. You're gonna record your share capital, which initially go to on the credit side, but now you're gonna record on the debit side because you are eliminating it or you are canceling it. You say share capital in S Limited is 50,000, retained earnings in S Limited is 20,000. Then you had the goodwill, which is now created. So that one you're gonna carry it further into our consolidated financial statement. So you still gonna record it on the debit side as 10,000. You don't record it on the credit side because we are not eliminating it. You're gonna carry it further into recording of our consolidated financial statement. So you're gonna remain it on the debit side as 10,000. And then you have investment in S Limited. So investment in S Limited will be represented by the value that you purchased that shares of S Limited, which you purchased the shares of S Limited by how much? Investment in S Limited for 50,000 shares. I purchased them by using the value of 80,000 rand. So you record them at 80,000. So the purchase difference, it's the one created by the 10,000. Then it means you eliminated the owner's equity at acquisition in the books of S Limited. Then after you eliminated those intergroup items and together with the acquisitions of the S Limited, now you're gonna record the consolidated financial statement. So on your consolidated financial statement, you're gonna have a property, plant, and equipment, which is gonna be the one from the current being the 50,000 plus the 60,000 from the S Limited. Then you're gonna have the value of 110. Then you have your non-current, which is gonna be represented by the goodwill that was created, which is 10,000. Then when you add the two, they're gonna give you 120,000. Now you go to the current assets. On your current assets, you will have the trade and other receivables, which is the one which it was the 40,000 from the P Limited plus the 15,000 from the S Limited. When you add the two, they're gonna give you 55. And then you have the inventories, which you have your inventories of 20,000 plus the inventories of 35. When you add the two, they give you 55. And then you have the cash and cash equivalents. The cash and cash equivalents that we had from the book of P Limited, which it was the cash and cash equivalents, which it was the 25,000. Then you add it with the 58,000, which is the one shown at the best bank in your pre-adjustment trial balance. Then you have, when you add them together, they will give you 83,000. Then when you add all your current assets, they will give you a total value of 193. Then the 193 from the the 120 from the non-current assets plus the 193 from the current assets, they will give you the total assets of 313. Now you go to the last part, which it will be the equity. So on the equity, you will have the share capital, which now we are focused only on the one for parent, which it will be 100, because that 50,000 is now eliminated. And then we have the retained earnings of the parent, which is 80. The other one for 20 is eliminated. Then 100 plus 80, they will give you 180. Then we go to the non-current liabilities. Then we're gonna have long-term borrowings. So the long-term borrowings will be reflected by the loan that's shown in our pre-adjustment trial balance of 100,000, because we didn't have any loan in the books of subsidiary. Then we record it as 100,000. So those loans, the 1 to P and the S, they are eliminated. We're not going to record them at the end because we eliminate them when we are doing our pre-adjustment, our elimination of the common items. Then we're going to have the current liabilities. So on our current liabilities, we're going to have the trade and other payables, which we have the 15,000 from the P Limited plus the 18,000 from the S Limited. When we add the two together, they give you 33,000. So the 100,000 plus the 33,000, they will give you as 133,000. So the 133,000 from the current, from the liabilities plus the 180 from the equities, then they're going to give you as the total equity and the liabilities of 313. And is there any question up to this point with regard to the acquisition of subsidiary, the wholly owned? Are we fine there? Because from now, the next part, it will be dealing of the acquisition of subsidiary, but which it will be a partly owned, not wholly owned. So in that case, it won't be 100%. Instead, it will be the certain percent can be 75, 25, 60, 40, 55, whatever. But as long as we regard the company as a subsidiary, if we own at least more than 50%, 51% upwards, then that person, we can regard him as a subsidiary. Any question? There's no question.
Yes.
Okay. So from learning number 3 is whereby we are dealing with the acquisition of a partly.
Hi, my
Hello, Tidibona.
Yes. You know what? I just need a lame reminder. Let me call it that. Remember when I offer me as a parent, let me say I'm P Limited, ne? Then I'm giving loan to S Limited. On my side, there will be bank and what, like loan what to S Limited as 2 accounts. Remember when there was a transaction, there was always 2 accounts. Okay, there's at least 2 accounts involved.
Okay.
In this case, it's going to be bank and loan to S Limited. Am I right?
Okay, when you'll be drafting your journal, right? You will have the debit and the credit. And then you said you are what?
I'm a parent. I'm P Limited parent. Yeah.
Okay. We draft the book of parent limited. So on your journal, because we are offering the loan to S, right?
Yeah.
So your bank is gonna decrease, right?
Yeah.
So it means on your debit you're gonna have loan, which it will be 80,000. And then on the credit side, you're gonna have bank because your bank will be decreasing by 80,000. So the 2 account affected, it will be the loan account and the bank. So in this case, this 80,000, because it will be owned to you at the end. Now it comes as an asset for now.
Yes.
Because 80,000 is owned. This person needs to pay this 80,000 at the end.
Yeah.
So it will be, that's why we debit it. It's gonna be debited, which is its form like it's an asset because it will be loan. Then you say S Limited. So your S Limited, it will be your asset in this context. Yes. And then when you will be reversing is whereby that 80,000 is gonna go to the credit side, and then which is to be S Limited on the credit side, and then your bank now on the debit side because you will be reversing.
Oh, okay. And then S Limited, how, let me say for interest sake, and then he's gonna report it as a loan, and then when he reverses, he's going to do opposite side.
Because remember on the book of S Limited, the first transaction, it's gonna be reported as on the debit side of his book, it's gonna be bank of 80,000. And then on his side, again on the credit side, it will be loan P, and he will say loan P Limited. So it means so he regards P Limited as his he regard the P Limited as a liability, that side.
Well explained. Thank you so much.
Okay.
I
But
just want to
in
remind.
But in this case, because now we are doing it as a contra account, so we're gonna only focus on the loan side. We forget about the banks. We only focus on the loan side. The loan S limited, the loan P limited.
Oh, okay.
That's why when we do our reversal, you said loan on the. Let me go back to that thing. When you do our reversal, you said loan P limited. You see, like, let me show. Can I show this on the Excel so that you can see the reversal part of it? I showed as an individual books, and then from there we do our reversal.
Yeah, I can see on page 26. It's here on 26. Yeah.
All right.
Yeah.
Anyone who have a question?
Thank you so much.
Cool. No one having a question with regards to the previous learning units that we have done, learning unit number 1 up to 3. Because I don't want to start learning unit number 4 because I'm not even going to finish it. We are left with 9 minutes. Okay.
No, we are going to learn in unit 3. We didn't cover it.
Sorry, learning unit number 3. Learning number 3 is the one dealing with the, I think, let's see, the partly owned subsidiary. Yeah, the one which is gonna have the percentages. They're moving from, it's no longer owning 100, you can own 60, 50, 51, 75, depending on the number of shares acquired in that particular company. But also that one we're gonna do it with it next week. So I think next week we're gonna cover lead number 3 plus the learning number 4. But I think it might be 3 because learning number 4 is too long and it needs you having a solid background on the prior 2 learning unit, which is 3 and 2. So go and at least try to check what's happening on learning number 3. Even if you don't understand, you can flag it or mark it on your side. Then when we meet, then you can ask a question that I was seeing. I was doing ABC on this part, and then I didn't understand this portion. How do we explain this portion? Then I can clarify it to you so that you can able to understand it at the end. So next week, I hope we're gonna do learning number 3 and maybe part of learning number 4. If maybe we might also do the whole of learning number 4 because it will depend on the examples and the questions that they had. Okay, someone was up. Yes, no.
Yes, I want to know that for next class, where do we find the link and what is the time for class?
Okay, where did you get this link? Let's start it there.
No, this one I found it in Telegram.
You found in Telegram. Normally, UNISA Florida was supposed to send the link to the registered student. So I don't know in this case, what did they do? Did they create a email whereby they send it to the registered student or how? I didn't know how it worked. The only thing I know that they just have to present the class. They're gonna send the link, which they send the link to me, and then me I join via that link.
So this is a facet class also. Because we have another classes that we're continuing with. That's in learning units 8 onward.
And then unit number 8.
Yes.
I think that one is the facet one. This one is not the facet one. It's the UNISA one. It's organized by UNISA Florida.
Oh, I don't know about this one.
This one it just started today.
Oh, okay.
Yeah, that's why we are far way behind, because by right, if we were not supposed to be in learning number 1 and 2, we're supposed to be somewhere in 8 and 9.
No, it's fine because we were not attending the last one for learning units 1 and 2.
Okay.
Yeah, this one is very helpful.
They sent through email, ne?
Oh, okay.
Mm.
All right. Thank you.
Okay.
Marcela, where can we access the slides?
The slides I'm gonna share to you, Nisa. I think they will communicate with you. I can also, because this group, if I put something on the chat box, you can able to see it at the later stage. So even if you can join while alone, you can able to see on the chat box. So I'm gonna put on the chat box where you can able to access that slide.
Oh, okay. Thank you so much.
Okay.
It was the fruitful.
Sorry?
Yeah, we have class next weekend.
Yes. We're gonna have a class. If there is no class, like if you can, more the communication will be communicated via on this chat box. So the slide will be, I will communicate where you can able to locate the slide. And up to so far, we are having a class next weekend.
Okay, thank you.
Okay. And also please note this class is being recorded, right? And then along the way, where you can find the slide is also where you can able to find the recordings of this class.
Okay.
Yeah.
Okay, thank you.
Okay.
Sorry, do you also deal with assignments?
No.
Oh, yeah. Cool.
Hi, sir. Can we stop the recording now because we're just asking general questions? I think the recording will be too long if we listen to all the questions.
Okay, no problem. I will tell my TO to stop the recording because the class is now done.
See you next week.
Okay, cool. Have yourself a lovely one and please take care in this COVID.
Thank you.
Okay, thank you, sir.
Okay. Because usually we have to have a
Thank you.
face-to-face class. Okay, thank you.
Thank you so much. Bye.